trade CFDs successfully and properly, we need to be able to apply what's called technical analysis. Now, technical analysis is a big word. Okay, it's a scary word. Now, the thing is, no matter where I go, if I attend one of those seminars, one of those conferences I tell you about, first thing people ask me is, what should I buy today? What will prices be tomorrow? What will they be next week or next year? Well, wouldn't investing be easy if we knew the answers to those simple questions? But to be honest, I don't have a crystal ball. I don't have a Ouija board. And if you think technical analysis is going to answer those questions, I have to disappoint you early. It won't. However, if you are attending this webinar with the hopes that technical analysis will improve your investing strategy, help you learn how to minimize your loss or risk, as well as finding the best trading opportunities in high probability trades, it will do that. Now, the term technical analysis is a complicated sounding name for a very basic approach to investing. Simply put, technical analysis is the study of price with charts being the primary tool. Now, I take the word technical analysis, I throw it in the trash can. Okay? Because it does sound scary. It sounds like this big scientific thing. If we just rename it charting analysis or chart analysis or reading charts, sounds a lot more friendly. Now, the beginnings of technical analysis were developed. It's not so long ago, in the 1900s by Charles Dow. Now think about it. You all know who this man is. You may not know it off the tip of your head. But Dow and Dow theory started this entire other field of understanding how to interpret the asset's value. You've all heard of the Dow Jones. Dow Jones is named after Charles Dow. Dow theory. Okay. He was the first one to start looking at the nature of prices and historical prices to determine what an asset's value was. Now remember, in the 1900s, the basic trading that we could talk about was stock trading. You know, there was agricultural trading, but it wasn't in a big market. But all of us, we weren't alive then, but the world traded based on knowledge and fundamental analysis. Nobody had ever looked at a price on a chart and applied any type of study to it. Now, Dow, even though he started this nature of technical analysis, he never put all of his ideas together. He wrote them. He was a genius. He had all of these ideas, all of these ways of analyzing, but he never put it into one package that made any sense. It wasn't until much later that somebody took all of his theories and put it together to understand charts and how to use these for properly investing. Now, you have to keep in mind, there is no mathematical formula for beating the markets. There's actually no indicator, no oscillator, no robot, no scanner that's going to tell you what to do, because you know what? The markets are made up of human beings. And the price of any asset, whether we're talking Bitcoin, whether we're talking the euro, whether we're talking X, Y, and Z stock, is really based on a consensus. Is what one person's willing to buy it for and what one person's willing to sell it for. When there's not buyers in the market, the sellers keep lowering their price so they can attract the buyer. When there's not sellers in the market, the buyers keep offering higher prices. Okay. So it's based on expectation. You expect the stock to go up. He expects the stock to go down. Now, even though nobody is matched up one-to-one, it's still the consensus of what is happening in the markets. And because it's also made up of human beings, all the things that affect us in the world, whether it's a traffic jam, whether it's a terroristic act, whether it's war in the Ukraine, a bombing in the Middle East, a ship sinking in the Gulf, whether it's a tornado, whether it's a hurricane, whether it's a snowstorm, whether it's a crazy politician, all affects the price of an asset. And all affects how human beings are thinking and interacting with the market. So ultimately, the only thing that doesn't ever lie in the marketplace is price. Indicators can be wrong, oscillators can be wrong, strategies will be completely wrong, black box trading systems, scanners, robots, because nobody can understand what's going on in people's minds. And you can't factor that in. So because humans are involved, I am sure that most of the world's investment decisions are based on irrelevant criteria. Yeah, let's give you a hypothetical. Here's a man, big man, works for a big bank, and he handles huge investments. Now, he's decided this morning he's going to buy several $1,000,000 worth of X, Y, and Z company. Shares. It's a little drop in a bucket for X, Y, not enough to make a blip anywhere, not enough to make a sniff. But on his way out the door, he has a fight with the wife. He gets out and there's a school bus blocking or a trash man blocking the driveway. Can't get his car out. The highway's backed up with an accident. He gets to work late. He's in a bad mood. So by the time he calms down his desk, gets everything open, he makes his trade 2 hours later. Okay. It had an effect on what could have happened in the marketplace. So if prices are based on investors' expectations, and knowing what a security should sell for becomes less important than knowing what other investors expect it to sell for. Now, that's not saying that knowing what a security should sell for isn't important, but if there is usually a strong consensus of a stock's future earnings that the average investor cannot disprove. Now, do you really care if X, Y, and Z or Amazon or Google or the euro, Bitcoin is worth the price it's selling for? Do you care that whether Bitcoin is worth $41,000 or not $41,000? Do you care if Amazon's worth $430, not $410? It's now what we do care about is it selling above or below the market expectations? What's going to push it up or what is going to push it down? Don't care what it's really worth. Now, as an investor, we do care what something's worth. If you're going to buy the dollar at a low point because you're going to put it away and sit on it for a month at end, or you're going to buy X, Y, and Z company shares because you just want over the next 10 years that it's going to go up in value and go up steadily over the next 10 years. Or you're going to buy gold. You don't care that gold goes up today, down tomorrow, up today, down tomorrow. As long as you're buying gold at 1,200 and it's going to keep, but gold should be, based on all of your analysis, should be $2,000. Not tomorrow, not next week, but when the economy gets better or worse, gold's going to go to 2,000. That's all that you care about. So that person's looking for the actual value. As a trader using technical analysis, and as a trader, we're only concerned with where is the price today? Is it going to go up or is it going to go down today, tomorrow, or the next week? See, because technical analysis really doesn't help us much at all in investing. It helps us in trading. So technical analysis is based almost entirely on the analysis of price and volume. Because if we're dealing with a formula on a chart and a price, on a chart, all we have at our disposal is the open, the high, the low, and the close. Whether it's this week's open, high, low, and close, or the last 15 minutes, high and low. And in a lot of cases, we have volume. But these are the only pieces of actual information we have that we can make any analysis. So almost all technical analysis is based on the same numbers with just different statistical or mathematical formulas and different applications. Now, as I said, all technical analysis is chart analysis. It is everything and anything we do on a price chart. So one of the most important parts of chart analysis is price action and analyzing what we see on the prices. One of the most formidable ways of doing that is using what we call price patterns, triangles, head and shoulders, wedges. These ongoing patterns that have repeated themselves thousands of times over thousands of scenarios help us interpret what price is trying to tell us. Because technical analysis is looking at what has happened in the past, whether it's last week's past, 6 months ago, 2 years, and looking for things that will repeat themselves. What price was important to this asset last year when it was trading at this price? What price was important 2 years ago when it was trading at this price? You know, when Bitcoin hit $60,000 a couple months ago, what prices were important as it came down? Those prices aren't going to affect us when we're trading at 41. So when now that it's trading, I think it's around 41 today. So what prices were important the last time it was between 39 and 41? So as I said, the word technical analysis is a bit of a misnomer since it really isn't that technical at all. A better name for the use of charts to make decisions might be risk-reward analysis or even market psychology. Sure, there are some complex mathematical concepts involved with some of its more esoteric indicators. But to its core, technical analysis is simply a method to determine if an asset is worth buying or selling in the short term. Once we identify this, we are ahead, or we can move ahead with a trading strategy. Simply stated, technical analysis is the study of data generated from the markets and the action of people in the markets. Such data includes price levels that have served as turning points in the past, the amount of stock being bought or sold each day or volume, the rate of change of price, the momentum an asset is moving up or down over time. You know, we talk about trends and trend lines. These are just lines that we put on charts. They show us how price is moving. Now, let's face it, and most of the time, price is completely random. It makes no sense. I would tell you 90% of the time, if not more, price is totally random. You can't make any sense out of it. So most of that is simply guessing. Now, there are certain times that price exhibits what we call non-random behavior. This non-random behavior, let me pop up some live charts here for you. This non-random behavior can be seen as uptrends or downtrends. Price moves in 3 directions. It moves in an uptrend, a downtrend, and sideways or congestion action. When price is moving the sideways congested action, we can't make any heads or tails out of it. We can't interpret it. When price is moving up or down, we can then start to make some understandings, some informed decisions. Now, if we learn how price is supposed to move, okay, or how a trend is supposed to move, and a trend should be moving in a push, ease, It's called making higher highs and higher lows, higher highs and higher lows. And if it's going, price is going down, it's making lower lows and higher lows, lower lows and higher lows. Okay. What it means, you have to understand how to read the chart and how to see price action and what a trend is. And anytime you do anything on a chart, you're doing technical analysis. Now, when price is moving in a trend, now remember, a trend is a series of higher highs and higher lows. In other words, let's forget about what happened back here. The market starts moving up. That means buyers are entering the market. As the buyers enter the market, they push price up. And at some given point, price reaches a level where the buyers decide, that's a little bit too high. And these buyers who've gotten down here said, oh, I'm taking my profit, and they take their profit. Because most trades aren't left to run. Okay, most people enter a trade with a target point. When that target point's reached, their trade is closed, and they've been happy, and they're booked their profits. So as this price reaches this point, the early buyers start to sell. Other buyers are sitting on the sideline saying that price is too high. So price starts to ease down, because as these buyers become sellers, price is easing down until they're all cleared out. And as price eases down, there's a point at which these guys who were moved to the sidelines say, that's a good price. I'm going to get back and jump in the markets. And what does that do? That pushes the price back up again. So each time that happens, price makes a higher high and then starts easing back down and makes a higher low. It will then start moving upward again to make a higher high. And at some point, when it reaches that saturation point again, it starts easing back down. And at some point, it goes back up. These are the steps in an assets movement. Now, granted, when I write them or I tell you about them, they sound like they're very, very defined. Well, to be honest with you, the market is very defined. Most of the time, it's random and it's a mess. But there are times when the market is moving in trends. When the market is moving in an uptrend or downtrend, we have well-qualified trends, we have sloppy trends. The more well-qualified the trend, the less random the market is, the more you can apply analysis to make smart trading decisions. And therefore, you should only be trading in a market. And believe me, there are a billion opportunities. The markets go on continuously. It's not like somebody said, oh, that house down the street, the guy needs to sell it fast. And if you want to go give him $100,000 today, you'll get it and it's worth 150. And if you don't grab it today, somebody else grabbed it and it's gone. Not in the markets. First of all, you can trade any asset all the time. And that asset will change later today, change tomorrow, and there's always another asset to trade. You're never missing out on anything. So by looking at your charts, you want to find what's called a well-qualified trend. And you do this visually or with trend lines on your charts. And this is the beginnings of technical analysis. Now, why do you need charts? What is a chart? It's a visual representation of price. If I told you the euro trading at 112.49 this morning and then went to 112.48, went up to 112.52, went back to 112.57, then dropped down to 112.48, went back to 112.47, and went over to 112.48 and went back to 112.53, and then went down to 112.37 and bounced back up to 112.60. Could you repeat that to me? Could you tell me what the euro did today? Could you make any sense out of what I just said? No. But if you were looking at a chart, you could have seen exactly what I just said to you. Okay. Because a chart is simply a visual representation of price. So when we're looking at our price and we see these stepping stones, what we see is price is starting to act in a non-random format. That doesn't mean it's going to offer us a trade, but we're applying all kinds of technical analysis now because we're looking at a chart. Now, charting also consists of drawing what we call support and resistance levels on a chart. These are levels where price has reacted at this level at another time in the past. Like back here, we see how important this level was here, here, and here. When this asset moves back up to this level, we're going to look at something that happened here. Down at these levels here, look at this. This price level comes from the bottom of this trend here, projected forward, and look what happened. It came down weeks later, back to that same point, moved back up to another uptrend, another resistance level, came back down to that same exact level because that was its support level. Now, most traders don't think of this as technical analysis. They think of this as, I don't know what they think of this, but this is the basics. Price action and reading the price on charts and looking back at historical pricing. Okay. Building trend lines, building your support and resistance levels, and looking for patterns on your charts. Now, granted, we all mix up technical indicators for technical analysis because all that we've been talking about now is part of this same field. But all of us want to find some shortcut to trade. And so therefore, we all depend too much on technical indicators. Now, personally, I don't use any of them. I'm a price action trader. I use basically triangle, support and resistance and trend lines. That's it. Now, what is the other reason you need to have these things? Is even though your buddy told you X, Y, and Z stock was going to go up today, you know, he works here, he gave you an illegal tip. And so you were going to go in and trade X, Y, and Z stock. Well, how do you know what point you should get out of the market? How do you know maybe your buddy was wrong? Or maybe the market already factored in all of these things and the price is too high now. How would you know when the market reached its peak and when you should get out of the market? Your buddy couldn't promise you it was going to go up to 65. He might have said, oh, well, you know, you can buy it around 49 and get out, you know, it'll probably hit touch out at 65. He doesn't know. But how would you know? What would you use to give you some knowledge? You'd watch the price on a chart. Now, once you've looked at prices on a chart, a lot of people want to apply technical indicators. These indicators are, in most cases, placed over top. Most of the indicators are placed below the chart, the price chart. Some are placed over top of the prices and the price action. Most of those are below. Now, keep in mind that technical indicators only indicate. They alert, they predict, and they confirm. A technical indicator is a mathematical calculation that can be applied to an asset's price patterns, like price or volume. Technical indicators do not analyze any part of the fundamental business like earnings or revenue or profits or whether there's oil production up or oil production down. It doesn't look at war. It doesn't look at anything. It only uses the mathematical formulas of price. But it can help alert us of a potential issue in that price action. It can tell us the trend is starting or a trend is ending. It can help measure the momentum of a trend. It can help predict future prices, or it can help confirm that price is moving. Because when you start to see when price starts moving up, you don't necessarily see the beginning of a trend. You may not even see the middle of the trend, but an indicator might tell you that there is a new trend developing or how fast that trend is moving. Now, remember, charts always have a story to tell. However, from time to time, those charts may be speaking in a language you do not understand. So think of technical indicators as the interpreters of the market. They look at price information and translate it into something simple. They give you easy to read signals. They help you determine how a trend is moving, or maybe that there's a buy or sell opportunity in price. So like we see here, we have all kinds of support and resistance. We have price falling down. We have it coming down to a support line and bouncing, and we're predicting it's going to bounce off. We're using a moving average across the top here, and a moving average is a technical indicator. It's one of the indicators that's actually dropped on top of a price chart. Down below, we have volume. Volume helps tell you whether the other traders believe in this price movement or not. Okay. Here we were looking at nothing but trend lines and trend patterns. Okay. Now here we've applied a chart pattern. We've looked at two supportive indicators that will help alert us and give us or support our decision to buy or to sell. So these indicators were dropped below the charts. So keep in mind that they are only calculated using the open, the high, the low, and the close. But you cannot ignore price action should be the first thing you're looking at. And then your price movement on the charts. These are your interpreters. They help you interpret it, but you must hear the spoken word before you can interpret it. So a technical indicator offers a different perspective from which to analyze price action. Some, such as moving averages, are derived from simple formulas and the mechanics are relatively easy. Others, such as stochastics, have complex formulas and require more study to fully understand and appreciate. Regardless of the complexity of the formula, technical indicators provide a unique perspective on the strength and direction of the underlying price action. So technical indicators are based on mathematical equations that produce a value that is then plotted on your chart. For example, a moving average calculates the average price for security and then plots it on your chart. Now, move indicators are broken down into two main categories, leading and lagging. Now, this is not like your child in school. A leading indicator isn't that he means he's heading up the class, and a lagging indicator doesn't mean he's flunking behind. Leading gives signals, tells you what the market might be about to do, where lagging confirms an action in the market. So a leading indicator tried to have predictive natures. But remember, if you're using opens, highs, lows, and closes, those have already happened. You can't use the close of a period that hasn't happened yet. So we try through mathematical formulas to bring these numeric values to have, or give these numeric values some type of a predictive quality. Where lagging indicators use the same piece of information, but they're trying to confirm what price has already done. In other words, one's trying to tell you an uptrend is going to happen. One tells you an uptrend has started. Now, these indicators are broken into major categories. We have trend indicators. We have momentum indicators. Momentum indicators are important. Trend indicators we kind of talked about. Momentum indicators tell you the speed of which the price is moving. So imagine you shot a rocket into the sky, a firework in the sky. Okay. It's got momentum moving up, 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 and up. As that momentum starts to wane, you would think that that firework or that rocket's about to tip down and come back to Earth. Now, that doesn't mean that it's going to right now, because the air could be getting warmer up there so it can go up higher, or maybe it gets picked up higher by a gust of wind. But as momentum shifts in one direction or another, it's telling you something about the trend. We have volatility indicators, tell us how volatile the market is. This helps us, number one, understand our risk, where the asset might go, where we would have to put our stop losses. Then we have volume indicators. Volume helps support a decision. Okay? If all of your analysis told you the Europe should be going up, or the euro should be going up, and when it breaks 116.12, it should be climbing. Well, if you don't see volume, you're not going to outsmart millions of traders around the world. You should see volume increasing to support your decision. But remember, when you're trading, you can use technical indicators. Like I said, I don't. But remember, covering more than 5 indicators is futile. You have people out there that have charts that look like roadmaps. There's so much stuff going on them, it's crazy. Okay. Using more than 3 is usually futile. Never choose indicators that generate the same signals. So many people tell me they use stochastics and RSI. Well, they do basically the same thing, tell you the same thing. So what you do is you have 2 signals to tell you the same thing, that use the same numeric values to tell you, so both of them tell me the assets can go up, so I'll buy. You want to confirm your strategy by using an additional indicators to substantiate a trend suggested by another. And then learn what indicators are and why you should choose one indicator instead of another. To find the best technical indicators for your trading approach, test out a bunch of them singularly and then apply them in combinations. Regardless of whether you're trading stocks, forex, futures, it's often best to keep it simple when it comes to technical indicators. You may find you prefer looking at only a pair of indicators to suggest an entry point and exit point. At most, use only one from each category of indicators to avoid unnecessary and distracted repetition. So you want to avoid redundancy, but you have to keep in mind what we call multicollinarity. It's a statistical term that refers to multiple counting of the same information. This is a common problem in technical analysis that occur when the same type of indicators are applied to one chart. So avoid redundancy. The results create redundant signals that can be misleading. Some traders intentionally apply multiple indicators of the same type in the hopes of finding confirmation for an expected price. In reality, however, multicollinarity makes other variables appear less important and makes you less accurate in predicting. So find one indicator, add it to your charts, get to know it backwards and forwards, and then apply it to another. Then maybe you want to build a strategy with them. But don't take somebody else's strategy that tells you use this, use that, use that. And when this does that, and that does that, and this does that, you should buy. Because ultimately, the indicators are only interpreting or indicating. Price action is the only thing that can actually make any sense. And keep in mind, indicators don't tell you to buy or sell. They generate signals. They give you alerts. Indicators only indicate. So understanding technical analysis is the study of historical price action in order to identify patterns and determine probabilities of future movements in the market using technical studies, indicators, and other tools. Technical analysis boils down to 2 things: identifying trends and identifying support and resistance through the use of price charts and time frames. Because markets can only do three things. They can move up, they can move down, or they can move sideways. Now, price typically moves in a zigzag fashion, and as a result, price action only has two states. It's either giving you a well-qualified trading opportunity, or it's giving you a bunch of randomness. So remember, there is no magical combination of technical indicators that will unlock some sort of secret trading strategy. The secret of successful trading is good risk management, discipline, and the ability to control your emotions. Anyone can guess right and win occasionally, but without risk management, it is virtually impossible to remain profitable over time. So keep in mind, this is just a general overview. We have classes that'll teach you support and resistance. We have classes that'll teach you specialize in oscillators and indicators. We have one whole class on MACD. We have a whole class on stochastic. We have a whole class on RSI. Somebody just answered me, and I don't normally answer these kind of questions, but I'll give it to you in a handful. Spread betting is CFD trading. Spread betting is just what it's called in London. That's it. Spread betting is only available in the UK, and that's just what they call CFD trading. So thank you very much for joining us. If you do have any questions, please write in and someone will answer your questions. Have a great trading day. Bye now.